Welcome to the Invested Teacher Podcast with Kyle Pierce, Matt Bigley, and John Orr.
Hey, get ready to be taught as we share our successes and failures encountered during our real-life lessons, learning how to build generational wealth from the ground up.
Welcome, invested students, to another episode of the Invested Teacher Podcast.
Hey, today, everyone, we are going to be, first of all, welcome back, Matt. You had a busy week last week, and when we had, who did we have on?
Ryan
There it is.
Malcolm,
it was
the
Ryan
Canadian
Malcolm.
Idol.
That's right.
Canadian,
That's
the
right.
Canadian Idol.
It felt so long ago when we recorded that. So great to have Matt back here. And, you know, there's been something we've been chatting quite a bit about, as the invested students know from previous episodes. You know, while we are pretty excited about investing in real estate. We love the tangibleness of it. We love the scarcity of it. People always need a place to live. And just this idea of having something that could generate us income. That's like one of our main places. But the reality is that we invest in all kinds of different asset classes. And, you know, this idea of risk sort of has been floating around out there. We've heard a lot about it. And actually, when we chat with invested students, oftentimes this idea of risk pops up. And I think we have maybe an incomplete story of what risk really is, right? Like when I think about risk, I think a lot of people think you have to be risky. You have to do things that are like risky and scary and maybe like have low probabilities or lower probabilities of success in order to experience a higher reward. And through our conversations, we've sort of landed on something a little bit different. And actually, you know what? I want to say, like, I want to let the cat out of the bag here. Like, it's almost like we're going to like try to promote people to think about actually doing something that is low risk can actually be the greatest reward.
That's for sure. I think going to be something that we get to in this episode. And I think for us, when we think about this risk, and in the conversations we've had about risk, I feel like we've kind of stumbled on that. You know, like you said, Kyle. Some people think certain asset classes are risky. Oh, I don't want to go in the stock market because that's risky. I don't want to be in real estate because that's risky. Or, you know, like, hey, I'm going to be in mutual funds with my bank because there's low risk there. Or I'm going to be in, you know, I have my whole life insurance, you know, premiums that I'm contributing to every year. That's growing. That's no risk. That's low risk. Instead of, you know, I think people think certain asset classes have an immediate assignable amount of risk. It's like imagine like you had this like chart and each asset class was listed, you know, across the x-axis, the horizontal axis, and there was like
Math
a bar
teacher
chart.
John coming out. Look out.
Exactly. And there's a bar chart, and then up the side is like the level of risk, and it's like automatically there's a certain amount of risk that is in that asset class. So if you can imagine real estate investing, when I talk with family members, other people, they're like, oh man, that's so risky because there's so many intricacies and so many things to think about. It's so risky. But instead, you know, you should be thinking about, I think, how much risk for each individual. As I think the risk changes, not because you're like tolerance for the risk that's there. It's actually less risk to you when you have information, when you know about something, like when you have a certain knowledge level about something, it becomes less risky for you because you're completely involved. Like think about, Kyle, your and I business, you know, of you know, helping other math teachers, helping other district leaders change their math program. Like, we run a business to help people do that. And somebody might say like, oh, you're a business, like you're an entrepreneur and you're running your own business. You're not you know, like you're a math teacher over here. It's no risk because you have your fine pension plan. You're going to shift to all of a sudden run this business. And you're like, that's so risky. But like, actually, it's like, we've been doing it for a long time and we know exactly how the intricacies intricacies of this business works. And it's actually no risk for us because, like we know so much about running this business that it's going to run, and there's actually no risk anymore. Like we don't even think of it that way. And I think real estate investors who've been doing this a long time, I think the same way. There's no risk here for me. Each maybe deal has risk associated. You do that analysis for sure, but I think people's mindsets around asset classes need to shift a little bit about like where there's no predefined risk. It's all about how much information you have about, say, that industry, that asset class.
As you talked there, John, it made me really appreciate how investing, which should be something that's so based on, logic and, rationale and numbers, is actually so emotionally driven. Like the big banks would play on this, when they try to pitch you on a mutual fund that's low risk. Like we tend to associate risk with fear, and fear is what holds so many people back from taking those first investing steps. And I think about our audience. Our audience would be, largely educators or people with, pension, defined benefit pension jobs. Like we are trained over the course of our career to think incredibly conservatively. Within that's the culture of teachers, or the culture of nurses, or people who have those types of jobs. So I think we're talking to an audience that is, for the most part, pretty risk averse. And, I think a lot of our pre-conversation about this was about, the perception of risk. And so how we see risk, and how with learning, with experience, and with great partners, your perception of risk really changes over time. When I think about when we first started investing and how scary that was, compared to where we are now, a lot of my conversations with, potential real estate investors, they are just so paralyzed by the fear, by all the bad things that can go on. And, we talked about this many times on the show. People, and I had a bunch of these conversations at an open house on Sunday, like they just said, I've been thinking about this for years and years and years. So people are literally stuck by this perception of risk. So, some of my thoughts are, how do we mitigate this risk? How do we scaffold risk for, new investors, or even investors who've been experienced maybe in one asset class and are looking to shift over to another one? And it's been fun working with you guys, because we've evolved outside of real estate and taken on some things that for me felt risky because they were uncomfortable. I simply didn't have experience or know-how, or I'm not a human calculator like the two of you guys are when it comes time to, some of these number concepts that, that were involved in some of the other assets we got into.
Yeah, for sure. And it's interesting because, like, as I hear us diving a little bit deeper here, and I go back to this visual that, John had mapped out for us, and then, Matt, you've sort of like highlighted that when you look at this map of risk, where, it's almost like, John, you were saying you could like put different levels of risk based on a different asset class. And what I'm hearing you say, Matt, is that really that map, it's assuming that everyone is on equal ground. It's like assuming that everyone knows exactly the same amount, or maybe nothing about the asset class. And in reality, if you think back to the first time you sat down, at least this is a thought or a moment in my investment journey, when I remember getting my first job. John, you mentioned your experience getting your first job and like starting to like think about investing. I sat down with the big banker, and we sat down, and it was like, I did this like short little questionnaire. And like at the end, they were like, hey, you can invest in like higher risk stuff because you're young and you have time. But really, that what I'm recognizing now is like the reason why it was high risk was because I didn't know anything about any of the things on the page. Like I didn't know what a balanced fund was. I didn't know what like, money markets were. I didn't know about like what's an equity. I didn't know any of those things. So if you look at it and you come in and you know nothing about the asset classes, then I would argue, yes, that like matrix makes sense when you look at it and go like, woo, this one is more risky, because you're going in blind and you know nothing. And I'm picturing the clients that you're working with, Matt, who may be new to investing in real estate and they've been thinking about it. Here's the interesting part. I think there's like a question we need to ask these people, and this is for everyone listening right now, is like, if you've been thinking about investing in an asset class for a long time, it's like, what else have you done? Because if you've just been thinking about it, right? Have you been learning about it?
Ooh, I'm
Like
building my courage up.
Absolutely. So, John, you reference this idea of like building businesses. Alex Hormozy, he doesn't invest in the stock market and people think he's crazy. The guy's got like millions, hundreds of millions of dollars, and he doesn't invest them in the stock market. They're like, you could make so much money like passively just by putting it in the stock market. And to him, he's like, he knows more about building businesses, so he puts his money in startups that he knows he can help turn around or
Got
help,
like a direct hand in.
Exactly. He's like, for him, there's like no risk there, because when he goes into a conversation with the CEO of a company, he's asking all the questions, every single detail that he needs to know to determine whether he can do something beneficial with that company or not. Whereas when he goes and invests in any random company in the stock market where he has no hand in, he's not a member of the board, he can't influence in any way, he's feeling a higher sense of risk. So that's for him. For us, when we walk into a real estate deal, like we look at a deal and we don't look at it as risky at all, because we are going in and we're asking all those same, call it Hormozy questions. So we had a building, we had an 8-unit not multi-family, but multi-use building under contract. We knew on paper, we're like assuming all of these things, this number makes sense. We walk in, we do the inspection, we find out about all these other things. That's not risk. We're like, all right, no problem. Let's go back and renegotiate. Couldn't get a deal going? No problem. We walk away, right? No risk there at all. It's just dealing. It's what happens if this happens or if that happens. And really, in every single investment, when you think about it, whether it's you investing in yourself so that you can generate money or you can, start growing your wealth, or whether it's you going out and investing in an asset class, the reality is the more you know about that asset class, the less risky that asset class becomes for you, because you understand what's happening. I don't want to use the word risk. You don't understand the risks. You know what's required. That it's a requirement. It's not a risk. So I know when I go into a real estate deal that it's a requirement that I keep in mind that if the roof goes, it's going to cost us between 60 and 100,000 on a big building like that. Like we just know that. We know that ahead of time. That's not a risk. That's knowing that that is a requirement of entering into this world. So do the numbers still work, right? And then you have to go through all the lists. So regardless of the asset class, learning about what is required is the key. And that's what's going to bring risk down. So to me, I look at risk as almost like the unknown. The more you know, or the less you know about something, the higher the risk is for you. But the more you know about it, the risk now starts coming down. Of course, there's going to be surprises in any investment class, but if you can mitigate that risk through understanding and feeling confident in what's required of entering into that asset class, then the risk goes away and you just do what you expected was going to happen.
That's perfect. Like that. I think that like helps everyone right now go, making those decisions by saying like, look, I can mitigate any risk by making an investment in knowledge. And that's something that kind of brings my thoughts to some like another thinking about risk. And like in that question is like, what are you risking? Because I think a lot of times it's like, oh, I'm risking my money, but it can be like, I'm risking my time, right? Or I'm risking my relationships. Like these are the things that you're like, hey, it's not just about money, because Kyle, if I want to mitigate my risk, and you're thinking money, I want to mitigate my money risk, you actually have to like dedicate time to doing that. So now I've transitioned my money risk, idea into a time risk. Do I want to risk my time to learn about this asset class so that I can mitigate my money risk? And I think that's because I the example for a long time, you had been doing all this learning for a long time and constantly chatting with me about it. and me kind of I was at that time risk. I was like, Kyle, I don't think I have any more time to dedicate to learning anything else. You've already given me this homework. You've already given me this homework to do and learning on this area. We got to learn about, building a business. It's like, now you got to learn about the stock market. I'm like, I don't think I have time to learn about that. And it's like, because I didn't want to risk my time and probably and therefore my relationships tied to that, like my family time. Like, it's almost like there's only so much, things that can go around. So it's like, if I'm going to dedicate time to learn that, then it's like, I'm going to mitigate my money risk, but I'm now committing a bunch of time. So I don't know if I have that. And it took time and me and learning to kind of like slowly go, actually, I can, dedicate some time to learning that. And then therefore I've reduced my money risk over the long term. And so I think that's really, to me, the crux of the question. It's like, well, what are you willing to risk if you want to go down these pathways? Are you willing to kind of put this on the line or change this about your lifestyle or this? And that really becomes the risk factor for me.
John, that was a really thoughtful kind of breakdown of risk, and I like how you delved into really considering what you're risking, and I guess I was sort of really focused on the money part, but the time part, the relationship part's huge, and it takes me back to our previous episode on coaches and the role of coaching and how, like in your case with Kyle bringing this stuff to you, it's like Kyle has a lot of expertise. And so that expertise from a coach or a partner or a partnership, like a joint venture partnership, can really remove a lot of that risk and flatten that learning curve for you. And it can also help mitigate that time risk because they can point you in the direction around where your learning should be. And personally, I'm always like joking to my wife, like I'm obsessed with expertise. Like I'm not someone who wants to spend a lot of time on something without knowing that it's the thing to do. It's the way to go. It's the direction. And that's why I'm such a big advocate for coaching, because yes, experience can teach us things, but having that expert guide, having that coach, having that partner who has that expertise can not only reduce that perception of risk, but that actual risk, that realized risk by guiding you through things. And so I think I love the dynamic between the three of us as partners and friends, because a lot of our conversation, when I get off a phone call with Kyle, my wife says, that sounded like a business call, rather than a call with friends, because, we're talking about things, we're learning about things, we're chatting about things. And as we go, it's like you're reducing your level of risk because, that learning and that guidance, helps you overcome some of that perception of risk.
I love it. And, going back to like bringing up this idea of time and, Matt, I'm like you. I think sometimes I can get stuck in the weeds and thinking only about money is maybe the wrong way to say it. But ultimately, it's like when I think about investing, I do think about like the number, right? Like, and John's a really good piece for both of us to kind of remind us that like why are we like money is a tool. Like money isn't actually something that we want to just have a lot of. Like in my head I know that I am designed. I have a habit where it's like I feel like my goal is like if I could just hug a lot of money in a room in darkness and I would be fine. But that's because of my primal question. I want to be safe. I want to be secure,
Yeah,
right?
you need to hoard it. You're a hoarder on money.
I'm a hoarder of cash, right? I'm a hoarder of money. And that's something that like I have to work through, and having a partnership like you guys there can be really helpful for us to kind of see that. And John's really great at recognizing and always bringing to the forefront is like, what's the end goal? Because like, I can only imagine that, if let's say 10 years from now, 20 years from now, I am in that dark room holding all of these bars of gold and I'm just sitting there, that I'm probably going to want to do something beyond that, and I'm going to go, now what? And it really does come down to time and family and friends and relationship, like all of those things. Like that is why I want that security. I want that security so I can provide for my family, so that I can spend time with my family, so I have a good relationship with my wife and my kids, right? So those are really important things. And it reminds me again, like we are such Hormozy fans. So Alex Hormozy, if he ever listens to this, if he does a Google search, all of our transcripts are going to come up if he puts his name in. But he said something that really had an influence on all three of us. Recently, he said that, if we look at time and money as resources or as tools, he says that people spend the resource that they value the least. And that is a really interesting dynamic. That had a massive impact on me. I was actually driving back from camping with my family, and everybody was having their little independent like tech time in the car, and I was listening to Alex. And when he said that, I recognized that, holy smokes, like by default, I am willing to give up my time over my money. And my wife is the opposite. So Chantel is like, she'll spend the money first because she wants to value the time. And to me, I'm like, whoa, that's like, I need to like change the teeter totter on that. I don't want to go all the way to the other end where you're just like spending all the money and just like not thinking about money. Money is important. We still need it as a tool. But when I think about that and I go, holy smokes, like I am so willing and dedicated and committed to spend pretty much all of my spare time. I still commit time to my family and to my kids and all of those things. But all the other time, like I commit all of that time towards spending it, towards trying to, generate more capital, to generate more wealth. And again, not necessarily a bad thing, but it's something that we need to at least recognize that's happening, and that every decision I make is either, I would argue, probably either one of those two things. I'm either willing to pay someone to do something for me to give me time, or I'm going to use my time in order to try to save that money or to earn that money. And that's something that I know I need to do some more thinking about, especially moving forward as, we try to look at ways that we could continue generating enough income to support our families, to obviously have, support ourselves into the future, but then also to leave a little bit of that legacy wealth for, the next generation.
Yeah, and I think that's a good pairing with the last point that you were making with thinking about what you're risking. Like we have this time money trade off with risk. If you compare those two, you can help kind of clarify where the most risk for you is, and do you want to transition that into something, into the other side. So if time is if me dedicating time is the risk right now, so that I can mitigate the money risk, then maybe I'm like, what, maybe I could spend a little bit more money, gain back the time, and therefore I'm making that risk statement. So it's that balance that you have to kind of play with. You have to think about where that risk is going to be for you. And I think that's like, what's like, Kyle, when we meet with, math district leaders across North America, the first question we always ask them is like, well, what do you want to have in the end? Like, what's your goal? And then from there, we can backtrack how to get there. And I think that's the question everybody has to ask right now. It's like, okay, well, if I want to mitigate risk, what is the risk that I'm mitigating? And what is my like time money balance right now? Where is that askew? Is it askew? Like you have to kind of think about those two things before you can say like, what asset classes are risky for me.
I love it. And I think, when you're beginning that journey, and I picture again myself when I started, as a 23-year-old teacher, and I sat down and I started like, to think about investing. At that time, it's very hard. Like you're just thinking like months ahead, right? You're just like, hey, I just want to make sure I'm doing okay in my job, and that maybe I can buy a house in the next couple of years. Like you're thinking very short term, for hopefully long term gains. And in reality, it's interesting because like I know for me, like if you have this vision of me hugging those bars of gold in a dark room, I'm looking at that and I'm going, really what I'm converting that to, or trying to work myself through, is that, hey, I'm doing this other investing, these businesses, real estate is a business as well, right? Other asset classes, options trading, and some of these other things so that I can generate income, not necessarily to directly fuel or sustain our lifestyle, but really it's like I want to take that money and I want to turn those into the safety, right? My bars of gold over there, that is just the safety. And for me, I think that's what's turned me on so much for the whole life policies, right? The infinite banking process, and really not using it for infinite banking necessarily for those who have read about it, but more or less to turn it into bars of gold that is super safe, so that I have that that sense of security over here, but then I still have the tool where I could, I can take a policy loan against it and I can still invest in a really great opportunity. It might not be something I focus all my time on into the future, but I want to know that I have it there and it's available to me. And it's not necessarily just floating around in a stock market, or it's just floating around doing something else. Like, it's very secure. So I look at that as like my bars, my gold. So when I think about this, like really, I want to start talking, guys, about some big ideas. And I think for me, I think the big idea for those who are listening is to think about, what is your relationship with risk? What does it mean to you? I hope that today, through this episode, you've kind of thought maybe a little bit differently about what risk is. And if you're looking at risk in the traditional sense, then maybe it means that you have to start digging in and doing some more learning. So, what asset class or classes, you don't have to just focus on one, but you need to start somewhere. You need to start thinking about, which one am I going to learn more about, so that when I enter into that world, that I feel like it's not a risk anymore, that it's just a requirement. It's just, if you open a restaurant, it's not risky to open a restaurant. You just need to know, how do restaurants operate? What's common? What happens when customers go away? Like, you just need to know what's involved in opening up that business. And the same is true here in this particular regard. So what is it that you're trying to generate the wealth for? And where is that going to go? And what does that look like over time? Like, are you like me and you want to, generate enough money and wealth, or enough of an investment so that you can start putting it into something that's safe so you could just feel secure? Or are you the type of person that you're like, hey, I'm an Alex Hormozy type, and I'm just going to keep investing in this one thing that I'm amazing at? Think about one of Matt's clients who's like just this like crazy, real estate mogul who's just constantly flipping properties. Like, that guy, like, it's not risky for him. He knows so well what he's doing every single time, and he loves doing it. So that's him. Like, that's probably his safety, right? Like, he looks at that as zero risk at all. So what is it for you? Lower the bar on the risk by going out, learning about what it is that you're going to be focusing in on. And again, I hope I'm not stealing everybody's big takeaways here from the group, but like Matt says, find people that can help you get there faster, whether you've got to pay through a coaching program or a mentorship program, or maybe there's some people in your inner circle that are doing some pretty important things. What value can you bring to them so that they say, you know what? Yeah, come and hang out with me. Every time I go do this or do that, I want you with me because you're bringing some value to them. So think about those things, and let's lower the risk on all of our investments.
And I think for a lot of us, I think we wrongly associate risk with doing something irrational or doing something stupid, or, and so I think that for all of us, we have to accept that we want to do everything possible to give ourselves peace of mind, to do our research, to do our learning, to have our partnerships. But there's always going to be some element of risk. I was talking to first time home buyers on Sunday, and I said, okay, you can have a home inspection, a financing clause, you can do all of those things. And when you actually make that offer, it's still going to feel really scary. So you still have to accept that you're going to have to take the plunge. That is part of winning. That is part of, rolling the dice. And certainly over time, you'll be able to stack that risk, and you'll be able to get into things that you either, as Kyle said, do a real deep dive into one asset class, or you'll start to venture off into other asset classes, as we have, and that perception of risk will really change. But we want to create as much peace of mind as possible for you, accepting that will always feel in the moment really risky. And when you look back on that, you will probably laugh at yourself about how risky it felt in the moment. And yet, how months or years later, it truly wasn't risky at all.
Totally. I think that's a great way to end it off here, Matt, is for, for us to think about that question and kind of think about, time being kind of the mitigator as well, as long as you're pairing it with knowledge. You've got that time trade-off with money, but also your knowledge, building that knowledge set so that things will become less risky. And I think that is kind of our suggestion, right? That's our way to go, but everyone has to make that decision. So you're going to go off right now. You're going to start thinking about that time trade-off, that money trade-off. Where can I dedicate some time to make things less risky? Or am I going to allow it to be, or am I okay with being risky so that I can save my time? So there's that trade-off. You got to make that decision. Folks, we want to thank you for joining us here on our podcast. And if you've listened before, hit the rate and review button, leave us a rating, leave us a review. It does help people find this show so that it can help them think about these things, think about risk, think about making decisions and getting into the real estate market or in any sort of asset class. If this is the first time, we want to welcome you here and hit that subscribe button so that you can get notified as we put out new episodes. We put out one every single week. This is episode 35, folks. That means there are 34 other episodes you can dive into on various topics around finance, personal finance, investment, real estate investment. So check those out and welcome if this is the first time you're listening.
And friends, we've got all kinds of links, resources, transcripts, and our Invested Teacher amazing investment book list over on the investedteacher.com website. Today's show notes can be found at /episode 35. That's investedteacher.com /episode 35. And hey, if you head on over there, you can get on our VIP club list. For especially a Canadian listeners. So those who are Canadian listeners, we've got a pretty cool little giveaway that you'll be a part of. But of course, from around the world, getting on the list will be helpful for you in order to learn a ton about investing, on ways that you can do things a little bit better. Like, hey, like John, helping people to refinance in high interest times. Like, what does that look like and sound like? How can I save a little bit of money? Or if you're like me and you want to start stacking some gold bars that you can still leverage. Hey, I don't know the last time you brought a gold bar to try to buy something, but it's hard to do. It's heavy. And a lot of people don't really accept it like cash. So, whole life policies are way better, way more flexible. So if you're looking for a little bit of that safety, that security, but you still want to have access to that thing we call money, that resource, getting on our VIP club list, you'll learn a little bit more about how you can do that as well. So head on over to investedteacher.com and check things out. If you're in the Windsor, Essex area, and you are looking to buy a property either for yourself or to invest in the Windsor, Essex market, hey, Matt's your man, not only to find the property, but also to coach you through and help you overcome some of those risks. We love our Invested Teacher students, and we look forward to chatting with you real soon.
If you would like to reach out to us to talk about coaching, partnership opportunities, as we talked about in this episode, mitigating some of that risk by leveraging our expertise, reach out to us at investedteacher.com /JV.
Awesome stuff there. All right, students, class dismissed.
Hey there, invested students. This content is for informational purposes only. You should not construe any such information or other material as illegal, tax, investment, financial, or other advice.